Today I will share with you why multiple time frame analysis is one of the most important tools that you need to master to become a consistently profitable trader, not only from a technical point of view but also psychologically. Also, I will discuss the multiple time frame analysis principles and what is the most important time frame. Also, I will share with you a great lesson that I have learned from Paul Tudor Jones. Hi, my name is Khaled Maziad and I am the founder of Trading Roadmap. As you read this disclaimer, if that's your first time here and you would like to learn more about how to develop your winning trading plan, become consistent and totally change your life, please start now by subscribing and hit the bell notification so you will not miss anything. Welcome back to the fifth module of our free trading course, The Trade Journey, and today we will discuss the multiple time frame analysis. So we will go through the importance of multiple time frame analysis and the market participants and the importance of the opening price and the time frame principles and the most important time frame, the high volatility and lower time frame, and only one thing that you need to remember and a great lesson that I have learned from Paul Tudor Jones. Then we're gonna have a recap and then we will end with the assignment. So first thing we need to discuss is the importance of multiple time frame analysis. Why the multiple time frame analysis is very important is it's very important to look at higher time frames even if you are a day traders, because many people have a misconception that if you are just trading from a lower time frame you don't need to look at higher time frames, and I'll show you exactly why this really important. Because you need also to understand that you are not only trading the market, you are trading the specific time frame that you are trading. And the multiple time frame analysis would help us in three main aspects of trading, which is the trade idea and the trade management and also psychologically. So when we talk about the trade idea, it will help us to see the big picture, and it is very significant, it's very important to understand the market context. And that's why when we started this trading course, we started our first module about the market structure, and understanding the big picture is very important. Also, it will define the risk, like by looking at multiple time frame analysis you will define the risk and also will define the magnitude of the trade, so or the magnitude of the move. Because I'll show you some examples, but in a nutshell, if you are talking about any trade, by looking at multiple time frame analysis you will know where exactly you are in the big picture, and then you can define exactly how to manage your how to think about your stop loss and how to think about your profit target. And that will lead us to the trade management, where it will help us to enter a new position and add to your existing position and also exit your position, because that's how you sometimes you will decide, do we need to let the profit runs, or we are in a higher time frame, we are in a range, so it is better to take partial profit now or even exit the trade. And also the psychological aspect of that is to manage your expectation, because when you see the big picture you will manage your expectation. Don't forget that we are surrounded by many unknowns while we are trading, and algos and use, and also the emotional aspects of trading, because sometimes traders are under massive pressure, especially when you are trading and there are some volatility or something. And understanding multiple time frame analysis will give you this peace of mind. And now also I would like to share with you the market participants from multiple time frame point of view. So the way we're gonna understand the market participants, we're gonna define them in four separate groups, which are the monthly group and the weekly group, the daily group, and the intraday group. And when we talk about the monthly group, I'm talking about anyone who is adding or taking position on during the month, and same for the weekly and same for the daily, like, and same for the intraday, because you will have some day traders who are gonna take just for a couple of hours or even a couple of minutes. So it's really important also to understand the opening price. I know many traders they talk about the closing price, but I'll show you why the opening price is very important thing. Even if you trade from a higher time frames, you need to understand the opening price on different time frames. And here's I'll just show you, like, it's very simple, like candlesticks 101. So you here we have the opening for a bullish candle, and then that gives you the direction. Because we have the color here is green, and that means we closed here, so that gives me the direction. I know that the information that I know from this bar, or what I know about this bar, is this market opened here, and at a certain point it went down, and then at a certain point it went up, and then it came down and closed here. Maybe I don't understand exactly how this happened, but I have some certain information that I know about this candle. And same story for the bearish candle. You know that it's opened here, you know, because it's read that the direction was down, and that's closed here. So you can refer to the opening price as a reference point. And what I mean by the reference point, once I know that I'm trading higher than the opening price, I know that we are going up. Once I know that we are trading lower than the opening price, I know that we are bearish and we are going in a downtrend, at least for this bar right now. And that's significantly important, especially when we talk about different time frames, because if that's a monthly bar, it's gonna be the same. So if I know that the opening is here, at any time during the month I'm above the opening price, that means we are up, the market is going up. Same story for the bearish candle. At any time I'm lower than the opening price, monthly, weekly, it's even for yearly. I look at yearly chart and the quarterly charts. It doesn't really matter what time frame you are looking at. The opening price just define exactly where we are. It's significantly important. And why is that? Because I showed you, like, it defines a market direction. It tells you exactly where it's gonna happen. And how can we use that? Because when we start to look at multiple time frame, we're gonna look at a higher time frame. You're gonna define exactly the reversal and the breakout trade in a different time frames. And when we come to combine it with the market structure, which was our first module, and the inside bar, which was our second module, the outside bar, which was our third module, and the pin bar, which was our fourth module, if you can combine it with that, then you will, it's bingo. You're gonna have a high probability chance to have a successful trade. And I will show you some examples right now. And we have here the British pound Canadian dollar, and as you see here, we have an outside bar and then we have an inside bar, and that's a weekly chart. And then look what's happened here. So looking at a higher time frame, let's pretend I'm looking just here on the weekly chart. So we got here, that's an outside bar, but that's a close. But let's pretend we don't know what's happening right now, and we are just trading, we are just looking at this chart right now. So I know that, let's start with this bar. I know that at these times this market opened here, this bar opened here, and then we went up. By went up, it triggered the inside bar. So this inside bar would trigger. And also, if you remember what we spoke about in the inside bar, because this one is near to the, it's very close to take out the high here, so I'm expecting we're gonna go up. But then what's happened here? It went back to the range. And you remember when we spoke about the inside bar, we discussed that coming back to the range is not good. But there's something happened before. When it comes back to the range, when it came back to the range, what happened here exactly? That the opening price shift. Don't forget, at certain point here, this bar was green because it went up, and then it shifted down and became red. That means we got a reversal. But what triggered this reversal? And it's not a surprise here that you're gonna trigger. You're gonna see here, I got this information that the weekly becomes red, and then I got here and a pin bar. I got a pin bar here. So that will give me opportunity, because now you know that the weekly is red and you got a signal on a lower time frame. So it's time now you can take a trade in this direction. And that's, you're gonna find me that's the first time now we start to talk about the trade, but it will not make any sense to you to talk about trades without understanding the market structure and what does the inside bar mean and the outside bar mean, the pin bar, and the multiple time frame analysis. But now we're trying to put everything together now, and you're gonna see here, yeah, now I can combine what I have learned from the previous modules now using multiple time frame analysis, and you will see here what happened. Market went down, and then we go to another inside and got triggered, and we will discuss how we go about multiple time frame analysis when it reverses to the other side. And also if you check that one, you have here the monthly the yearly chart, and when you see the yearly chart here, what we have here, we have an inside bar. And what does that tell me? It tells me that we are consolidating on a higher time frame. And how this gonna manage my expectation? It's gonna manage my expectations two ways. First thing, I know that I'm consolidating on a higher time frame. That's the first thing. Second thing, I know that this candle is red, and I know there is an inside bar here. So once I take this inside bar, and there is another thing about this inside bar, it's in the middle of the range, it's not near the high or the low. So yes, and I know, yeah, that's a yearly chart. But having this information, I manage my expectation that it's okay to consolidate, and that's a monthly chart, and that's what happened here. So if you are taking this trade on a daily time frame, you are totally managing your expectation by looking here, because now you understand totally what's happening on a higher time frame. I know it's consolidating on a higher time frame, so if I'm trading this on a lower time frame, I'm totally understanding what's happening right now. I'm managing my expectation. It's not only the technical aspect that I understand why, it's also I understand why that I need to manage my emotions. I need to be in control of my emotions and understand what's happening in the moment. And we gotta talk about this more and more. And it's very important to have this psychological aspect in your mind, because don't forget, as traders, we are under massive pressures many times, especially with high volatility sometimes. And if you don't have this understanding before you take the trade or during you take the trade and while you are managing the trades, that's why people hold losing trades and they got frustrated and exit early. That's why, because you don't understand what's happening. By managing your expectation, you will be able to manage the trade. And now we will go through the time frame principles. And the first thing that you need to understand about, and what I mean here by LTF is a lower time frame and HTF is a higher time frame. So the noise level on a lower time frame is always high, and is always higher than what's there in a higher time frame. And I'll show you some examples now. Just keep those points in your mind. Also, the structure is different. The structure from a point of view that trend and consolidate and the consolidation or range is different from higher time frames. Also, the third thing that you need to understand, the reversal or lower time frame happens first, and that's obvious. Also, the breakout on a higher time frame would be more significant than the breakout of a lower time frame. And I'll show you some examples like now. And if we look at this chart, and again that's the same chart we looked at for the British pound Canadian dollar. And what you see here, I'm here just zooming on this, and that's the daily chart. So I'm just zooming on this swing here. And what you will notice here that let's go step by step and try to analyze what's happening here. So we have this an inside bar, which means we are in range, and you got 1 2 3 4 5 6. The bar number 6 just took the inside bar and then reversed it back to the range, which is not a good sign. Now we are anticipating to take the other side, which we almost did here. But then what happened? We got another reversal. We got a pin bar, and the pin bar we reverse it back here. But do you notice something here? While this, like you see those 1 2 3 4 bars, do you see what's happening here? It's only 4 bars here, but you see here the noise level on a lower time frame, because that's the hourly chart. If you look at the noise level here, it's very high. You see, like it's very noisy because that is higher. And also I'll show you now, that's the hourly chart, like I just zoomed in. And also look at the 5 minutes. Whenever you go down on a lower time frames, you're gonna find it's very noisy, and if you are trying to manage the trade from here, it's very confusing. So that's one of the first principles. Second principle we spoke about is the market structure. You will look here, like we are here near this resistance, and then what happened here, we go to reversal. But if you look here, yes, in a higher time frame we are still in some sort of range, but you're gonna find the hero range, and then you're gonna have here lower lows and lower highs and lower lows and lower highs. But the market structure is different here because we are in a higher time frame. So that confirms what we have said, that it's a principle about the market structure. And also it shows you for sure that the lower time frame gonna reverse before the higher time frame, and that's 100%. No one can dispute that. The lower time frame gonna move first. However, you need to understand that the breakout of the structure of a higher time frame is more significant than the breakout of structure of a lower time frame. And that's how people sometimes don't understand which time frame to look at, and we will answer this question: what's the most important time frame? So, and you see here that's the hourly chart, that's the same exactly everything. And you will see here we have this range. If we are coming back to understand the range and the trend, so you have range, and then you go to break out of the range, and then we started to have the lower highs, lower lows, lower highs, lower lows, and starts the downtrend, and then we go to reversal from here. And that's a 5 minutes, and you can see clearly here it's very confusing. The noise level is very high. Without looking at a higher time frame, you don't understand what's happening here. Yes, the price is going down. Yes, we are in a downtrend. Yes, we have lower highs and lower lows, but it's really confusing. And that will lead us to the most important question that people always ask: what is the most important time frame? And I will share this answer with you, because many people just say, it's the higher time frame, it's the lower time frame. And to be honest, the most important time frame is the one that you control right now. And what does that mean? I just want to remind you about one thing. That's the time frame principle. We spoke about the noise level. The structure is different from different time frames. The reversal on lower time frame is going to happen first, and the breakout of a higher time frame is more significant. And also we have four groups of participants, which are the monthly, weekly, daily, and the intraday. And at any given moment, the multiple time frames gonna do one of two things. There is no other way. It's gonna go in the same direction, or you're gonna be in different directions. So we're gonna have the same direction, we're gonna have a conflict. What I mean by that, you're gonna find sometime that the monthly is down, the weekly is down, the day is down, and the intraday time frames are down. Or the monthly is up, the weekly is up, the day is up, and also the intraday time frames, 4 hour, hourly, 15 minutes, whatever is going up. Or you're gonna find the monthly is up, the weekly is down, and the day is down, and the intraday is ups and downs. You're gonna have this conflict sometime. So at any given moment, you're gonna have either time frames are confirming each other or they are negating each other. And what I mean by that, it's like I got this terminology from the poker age, which is the royal flush. Sometimes you're gonna have the royal flush when all the time frames are going on the same direction. To show you an example here, we are just focusing on this month now, and I just highlighted here the open of the bar. So let's go step by step and see what's happening here. We have here the monthly, the weekly, and also we have the daily and the 4 hour time frames. And let's go step by step what's happened during the month. So this bar opened here. From a monthly point of view, we traded higher first. So that means at this point, this bar was green because we were above the opening price. And then if you look at the weekly, we were up. We went up here because that was the 31st of December, and that's the month of January. So you have a couple of days in January start here. So we went up, and then what happened? This bar is an outside bar. It triggered an inside bar and got rejected. It's not only an outside bar by itself, but also it was an outside bar that's the failure of an inside bar, which is a good sign. And then what happened on the next week, on the next candle? It's a pin bar. So it gives you the conviction, it gives you high probability that you have a failure. So the monthly is down, you have a failure of an inside bar, and then you have a pin bar. It gives you more conviction to take the trade. And let's see what's happening on a lower time frame, even a lower time frame. So you're gonna have this some sort of range. You got an outside bar on the daily. So this bar started here, and you got this pin bar, got triggered, and then we came back to the range, and we are expecting that because we have an outside bar. That's what happened here, that it tried to trade up and then down, and then what happened? You started this sell off, and then you see you got another inside bar, and then you got a failure of the inside bar. And if you look at the 4-hour time frames, it's also going down, and it confirms all the signals that you are getting from a higher time frame. And that's what I call the royal flush. The royal flush is when all the time frames are confirming what's happening on a higher time frame. So I can say here the monthly chart is in control. Yes, I know that the lower time frame is moving first. However, it confirms what's happening on a higher time frame. But I want to show you also something here before we go to the next point. Notice what happened here. So everything here was going down. So at this point, the month was red, and even the weeks is still red. But what happened here? That we start to go up, and you gotta notice here the weekly went up. That was the same bar, which was inside bar, which means we are consolidating. So whenever we see an inside bar now, you know what I mean by inside bar. We are consolidating on a higher time frame. So I see an inside bar in the weekly, that means we are consolidating. I'm gonna see what's happening here. Market start to reverse a little bit. So remember what I said, it's gonna be on the same direction on conflict. What's in conflict right now? You have the monthly red, which is down, and then you have the weekly trading higher above the opening. You have the dailies going up, and of course you have the 4 hours is going up. So you have sometimes frames are confirming, sometimes frames are not. But who is in control right now? The lower time frame. Yes, I do agree that might be a pullback on a higher time frame because we are just pulling back, and we might go down from here. I'm not saying anything, but who is in control right now? If you are a day trader right now, you might do one of two things. You can either take this trade up, or if you are a short-term trader, I mean, you might take this trend up. But by having this understanding on a higher time frames, you manage your expectation, and you don't think that you're gonna have this trade forever and the trend is gonna go up from here, because you are looking at different time frames, and you do understand that the month is red and we are going down, the week is going down, and we are inside on a lower we are inside on a higher time frame. So having those all information and putting this all together, you can manage your expectation. It's not only the trade from a technical point of view, but you can manage your expectation, you can manage your emotion, and you can understand what's happening. And that's the best thing you will ever have, and that's your edge. That's your edge, because you have a better understanding than most of the other traders that they look for a 5-minute chart. They don't know what's happening on a higher time frame. I wish this is now clear for everyone. It's very, very important. Now let's discuss another thing, the high volatility trade, the high volatility and the lower time frame. And many times, like during high volatility periods, we expect the price to see a big moves in the lower time frames. And why is that? Especially you're gonna see this during the events. If you have like any news, if you are a stock trader, you're gonna find this during the earnings. If we have any reports, whatever the Fed, whatever happening, sometimes you're gonna have those high volatility periods in a lower time frames. You're gonna look at the chart and say, wow, like look at this. It looks like it's a 5 minute chart and 1 hour charts, but the bars look like the daily chart. I'm gonna give you an example here. So you have this bar, it's on a daily, and you can without looking at the lower time frame, you can understand that this range of a bar is larger than every one the previous bars. And then you're gonna see like here what's happening because it started a downtrend, and see even here on a lower time frame you high volatility. When you have this high volatility on the lower time frames, that means at this stage the lower time frame is in control. So never, the main aspect that I want you to focus on now, don't focus on which time frame is important. The right question is which time frame is in control right now. That's the most important question that you need to ask. So at this stage, the lower time frame, and I'm showing you here even the hourly chart. And here what I did, I just took this daily bar and I just put the range for it on hourly, so it's gonna be easier for us to see it and see what happened here. It went up a little bit, and then we have this massive sell off. And if you look at a 5 minutes time frame, it shows you exactly the same thing. It's a downtrend. But again, if you look, you're gonna understand what we have been saying about the different market structures, the noise level on lower time frame, the reversal happens first on the lower time frame, and how the breakout of a higher time frame, because we have this some sort of range here, and you remember that's an outside bar, and it's also was an inside, and then we got rejection. It tells you everything. And then you started this bar and you went down, and then you got confirmation from the lower time frame. And when you put everything together, you will have a high probability trade. Not only from a technical point of view, I know that I'm repeating this a lot today, but I just want to focus on the psychological aspect also. When you manage your expectation, you will not be frustrated, because most of the problems traders have, when I had those problems myself when I start trading, and sometimes because I don't understand what's happening, so I got this frustration. Sometimes I hold losing trades because I don't understand what's happening. You hold losing trades, you take massive revenge trading because you don't understand what's happening. But when you manage your expectations, it's gonna be significantly important for you to understand what's happening, and you can easily manage your expectations. You can easily manage a trade, and you can easily control those trades and control your emotion, because you say, okay, we are inside on a higher time frame, that means we are consolidating, I'm not expecting that much. If we got this breakout and we have a lower time frame confirming what's happening, yes, then I gonna take the trade. Otherwise I gonna close the trade, and then I will wait. That's how I want you to think about it. Now, if there is only one thing that you need to remember, is to know your time frame and to live in the here and now. And what I mean by living in the here and now is to understand exactly what's happening right now. What's happening right now is very important than what you expect, what you think, what someone is telling you, what they share on a Facebook group, what they are sharing on Twitter, what they are sharing on Facebook, what your friends telling you. No matter what someone is telling you, or what you think, or what you feel, I want you to understand what's happening right now. And there is a great lesson I learned from Paul Tudor Jones about living in the here and now, and that's from the book The Market Wizards. And he was asked by Jack Twigger about what are your trading rules that you lives by, and he answered this. He said the most important rule of trading is to play great defense, not great offense. You see what he's saying here? I just wanna, it's very great quote that I just wanna break it down step by step and show you like exactly how you can take a tremendous amount of wisdom from such a quote. He said its most important rule of trading is to play great defense, not great offense, which is to manage your, when you manage your positions, you need to think about your stop loss first before anything. And you need to think about not losing money before making money. That's the first lesson. Second lesson is every day I assume every position I have is wrong. That's living in the here and now. He doesn't say, okay, like, it's gonna be alright tomorrow, or let's wait to see what's gonna happen. He thinks that every single trade is wrong, and how can I manage this trade right now? Whatever I said yesterday, that was yesterday. Whatever I'm thinking about was before, that was before. Now let's think about this trade right now with the information that we have right now. Let's keep going. Every day I assume every position I have is wrong. I know here my stop risk points are going to be. I do that so I can define my maximum possible drawdown. So thinking about drawdown, if you notice here, he's not talking about profits at all. He's just talking about stop loss, maximum drawdown, how to manage a trade, playing defense. He didn't say anything about making money. Hopefully I spend the rest of the day enjoying positions that are going in my direction. And that's a good thing. If I have positions going in my direction, go for it. Just manage them. If they are going against me, then I have a game plan for getting out. That's another lesson. You need to have a plan to get out. Yeah, I enjoy the position that's going in my direction, but if there is a trade that's going against me, I have a plan to get out. Let's keep going. Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do, you are dead. Like, what a great, amazing, fantastic quote. Many lessons here. Like, I can talk here for days about this quote and how important and how we can learn from this. I hope that will help. So now, can I ask you for a favor? Like, if you like this, now I just want you now, while we are sharing, before we gonna have the recap, I want you to like now, and if you haven't subscribed, start now by subscribing and share this video. And also, I want you to comment. I'll give you an assignment that asks you a question there. So let's have a recap. So we discussed today the multiple time frame analysis and the importance of the time frame analysis, and we mentioned about it's not only the technical aspect, it's also about the psychological aspect and how managing your expectation gonna help you. And also we spoke about the market participants from the monthly, the weekly, the daily, and the intraday group. Also we discussed the importance of the opening price and how it acts as a reference point, and I know from there where's the direction of the market on different time frames. We spoke about the time frame principles, which were where we discussed that the lower time frame noise level is larger than the noise level on a higher time frame, and we spoke about the different market structure for the different time frames. And also we discussed the reversal on the lower time frames happens before the reversal of a higher time frame. And also we discussed that the breakout of a higher time frame is more significant than the breakout on a lower time frame. We spoke about the high volatility and the lower time frame, and also we mentioned who is in control and what's the most important time frame, and the most important time frame what's that in control right now. And in high volatility periods, you're gonna have the lower time frame in control, and the only one thing to remember is what's your time frame and living in the here and now. Now let's go to the assignment, and I want you to choose 5 different markets, and time frames, and I want you to analyze it and notice how can you define breakouts and how can you define reversals. And also I want you to start to have the combination of the inside bar, outside bar, and pin bar with the multiple time frame analysis. I want you also to comment below now and tell me how you perform your time frame analysis. Also, please feel free to connect with us on Trading Roadmap on the Facebook and Twitter, and please also subscribe to our YouTube channel. And if you have any questions, you can send me an email on Khaled at tradingroadmap.com. Thank you for watching, and I'll see you in the next video.